Hey everyone, happy holidays and welcome to another Dividend Stock Investing video. I want to share with all of you in the video today the 5 stocks that I will be purchasing in the new year in 2022. The next year is going to be really exciting. I've been thinking about my strategy quite a bit, and I'm going to share it with you in the video today. Also, what I'm going to do is go through my thought process because my themes, they change each year. And so I want to go through the themes I have had as a dividend investor for the last few years and how my themes have evolved each year. I hope my thought process can help you at home decide your own strategy for the upcoming new year. I'm really excited about the video today. Happy holidays, everyone. Get ready for a really exciting dividend stock investing video. Welcome to PPC Ian. This is Dividend Stock Investing for everyone. All right, everyone. So I'm going to jump right into the video today. I want to go through my investing themes over the years, and then I'm going to jump into the stocks. For those that don't know, I have very detailed timestamps in the description below. If you value those timestamps and you appreciate them, please go ahead and smash that like button. It really helps me out. It helps this video and other videos reach more folks out on YouTube. So as you can see in front of you right now, I want to go through my investing strategy. And so the first thing I want to do is talk about 2020. So actually last year at this time, we're still in 2021. And so during 2020, many of you remember this was the year of the pandemic, and I was buying dividend stocks almost daily. I was buying them in small tranches because I had no idea how far the market would plummet. And so I was going small day by day. But I was buying nearly every day, especially when the market tanked. And what I did is I went heavy on core stocks like SBUX and 3M, but I also went pretty heavy on some other core stocks like McDonald's, the Home Depot, and others. And so that was 2020. The market was in free fall. My strategy was all about gaining value, and buying the best world-class dividend stocks because during that time, I had no idea what the future would hold. I didn't know the rebound would be so quick, but I did know that these world-class stocks like SBUX and 3M and Johnson & Johnson, that they would recover just fine. And so I had a lot of confidence buying them when everyone else was just selling and panicking. And so that was 2020. Now, as you see on the screen in front of you right now, my theme changed in 2021 just a bit. Basically, we're still in 2021, so we're not done quite yet. But my theme this year, really, we were coming out of the pandemic and we were coming out of this shelter in place and kind of looking inward and being conservative, being scared. And so I looked at 2021 as a year of looking outward and towards the future. I was approaching this year with a high growth, long-term focus because I know I went heavy on my core stocks in 2020. And so I was thinking 2021, Ian, let's look at the long term. Let's buy some of those really fast dividend growth stocks. And so I added some names this year, such as Utz Brands Inc., which pays a really small dividend, but there's opportunity for it to grow pretty quickly over the long run. I even bought some non-dividend stocks like Coinbase and Dutch Bros. I added a few tranches of Apple, which I'm very happy about. And so that was the strategy for a lot of the year. Now, I do want to give a shout out. My friend Russ from Dapper Dividends. I will actually, in the pinned comment below, link to his YouTube channel. Russ is also pretty active on Twitter. I will include in the pinned comment below a link to Russ's Twitter and also my Twitter. Make sure to check us out there. We're pretty active on Twitter. But one of the things I noticed that Russ was doing is he's buying PepsiCo, one of my favorite stocks of all time, actually my number 2 favorite dividend stock of all time. He has an experiment going where he buys it weekly, and he's been doing this for quite some time now. And this really inspired me and this is why I love the dividend community so much, and I love all the comments. Make sure to drop a comment below. I like to look at all the comments. I try to respond to most of them, and we have a great community. And so Russ inspired me, and I started buying Johnson & Johnson pretty regularly in the last few months. My patrons know this, actually. I'll include in the pinned comment a link to my Patreon where I share all of my stock trades. But I've been buying Johnson & Johnson almost weekly, and that was inspired by Russ. And so whereas this year in 2021 started out with a outward focus, kind of looking towards the long run, my strategy has been morphing a little bit over the last few months because I'm preparing for 2022. And as you can see on the screen in front of you right now, my strategy has been inspired, and I'm starting to look back towards some of those core stocks, especially that are trading at value levels. And so in addition to JNJ, I've been adding some Raytheon technologies. I recently did a video about that. I'll link to it in the pinned comment and the description below. I also have been purchasing 3M. And so what I really was also inspired by recently is on my Patreon corner tier level, I did a complete stock portfolio update for all of those patrons. So they got my complete updated stock portfolio percentage allocation to each position. And I started looking at my allocation at my various positions. I have 49 dividend stocks, which comprise 98% of the portfolio. I have 6 non-dividend stocks, which comprise 2% of the portfolio. I started looking at my top 15 holdings, which make up 61.6% of my portfolio. I would like that concentration of the top 15 to be even higher. And so what I started realizing is I basically came to the realization that focus is an underappreciated strategy. As I get older, time is so limited and it goes by so quickly. As my portfolio gets larger, net new capital I throw at the portfolio, it has less and less of an impact because the snowball is getting bigger. And so what I realized is, Ian, if you really want these core stocks to be bigger, if you really want that, you have to focus on them. And so this started getting my gears turning, my head spinning, and I was thinking towards the next year, and I'm like, you know what? Next year is going to be a year of focus. And so as you can see in front of you right now, this is my 2022 strategy, and it evolves each year. I like having an evolving strategy. It keeps things interesting. I try to have a different approach each year. This year, this upcoming year in 2022, it's a year of change for our family. We're going to be moving. We're leaving California. I'm really, really excited about this. And I actually shared some details about that with my patrons over on Patreon. And with any move in life, there exists two factors. There's an excitement of learning new things, but there's also this need during a time of change to find some stability and comfort in old routines. And so it's really that second point where this year I want to double down on those comfortable, sleep well at night stocks that bring me and my family so much comfort. I'm going to share 5 stocks today in just a minute, and I'm going to go through each of them in a lot of detail. This is the topic of the video today. Now, what I will say as really this theme of the excitement of moving and learning new things, I will also this year, on a comparatively small level, be adding and continuing to add to my cryptocurrency portfolio, which is largely cash flow focused. And so if you have not checked it out yet, I have a cryptocurrency strategy. It is all about earning passive income and cash flow in cryptocurrency. I will link to that in the description and the pinned comment below. Make sure to head on over there and subscribe because I have some amazing content. It's a smaller percentage of my portfolio, but that's where I'm going to learn a lot of new lessons this year, gain a lot of excitement, have a lot of fun, is on the cryptocurrency side of things. I'm going to do it on a smaller level, whereas on the dividend side of things, I'm going to rely on those sleep well at night stocks. And so you all have to be wondering right now, which stocks have you chosen, Ian? Which ones are you looking at for 2022? And so as you can see in front of you right now, these are the 5 stocks. And I want to go through these with you in the video today. And I actually have some news and some updates on each of these that I want to share because there was just some news, for example, on 3M Company, which has been so underappreciated. No one is talking about it. I don't know why. But I will be talking about it. And so I list these in priority. There are 5 of them here, and each of them fill a different need in the portfolio. The first one is my number one favorite stock of all time, which is Johnson & Johnson. And many of you know that this business will be splitting into two businesses. There's going to be a consumer-focused brand business. There's also going to be a business focused on the medical devices and pharmaceuticals. And so the reason they're splitting, in my humble opinion, may be to unlock some shareholder value, the way that United Tech did when they split apart. But more than likely, I think it's also to shelter legal risk. I've covered this on my YouTube channel here before. And so what I want to do before the company splits into two is continue to up my position, because right now Johnson & Johnson is 7.2% of my portfolio by size. I'd honestly like to see that get closer to maybe 10, 11, 12%. And so I have a lot of work to do, and I'm now buying it almost weekly thanks to the inspiration from my friend Russ. And so Johnson & Johnson right now is trading at a forward PE this year of 17.3, forward PE in 2022 of 16.35. I highlight those cells because I believe that is a attractive valuation for such a great company. Now, this company has a starting dividend yield of only 2.5%, but the payout ratio is really low at 43%, so there's a lot of room to increase the dividend. That's why I highlight the payout ratio. I like to highlight the cells that are inspiring to me, that are exciting, that are exhibiting some kind of value. Now, this company is only growing the dividend on average each year by 5.79%, and so it's a little lower than I like to see. I like to see 7% or higher, but given the low payout ratio, there's certainly room for them to go a little bit quicker in future years. Now, I already mentioned it comprises 7.2% of my portfolio, as you can see on the bottom part of the table here. Now, one thing that I'd like to say about my strategy today is I am not saying that these 5 dividend stocks are going to be the best performing stocks in the stock market next year in 2022. What I'm trying to say is, for me as a dividend investor, my theme changes each year. And for my personal needs, this theme makes a lot of sense for me in 2022, where I'm really looking for some stability, some sleep well at night, because there's a lot changing in our life. We're moving. And so with all of that, I always like to double down on the safe stocks that I love the most. And so that's why it makes sense for me. But I'm not trying to say these are going to outperform the market. These are going to be the best performing stocks. That I don't know. But what I do know is these stocks, on average, are probably going to have a lot less volatility than the underlying stock market, a lot less max drawdown in a market collapse, and are going to have superior dividend growth, superior cash flow characteristics, which is what this channel is all about, living off of dividends. And so with that, as you can see in front of you right now, I want to go through the next stock on the list in priority order, which is 3M. A lot of people are not talking about 3M these days. I don't know why. It's a industrial, but in the categorization here, I also include science and technology, because I think so many people feel that they have to go with internet stocks to get technology exposure. But what they don't realize is even companies like 3M are doing so much science and tech innovation. And it's a tech stock in many ways that's trading at a very low PE. Now, the price per share as well is well below $200, which baffles me in the market we're in. I believe this is trading at value levels, in my humble opinion. And so based on the forward earnings estimates, it's trading at a forward PE this year of 17.96, next year of 17. I highlight those because the PEs are very attractive for the quality of the business given the overall stock market and where it's at. I highlight the starting dividend yield of 3.35% because that is amazing as a starting yield in the environment we're in. Now, the payout ratio is a little higher at 60%, so they might not be growing the dividend quite as quickly in the next few years until the earnings catch up. I think their payout ratio, they probably don't want it to be too much higher than that, but we shall see. And their 5-year dividend compound annual growth rate is a little better than Johnson & Johnson's at 5.92%. The last dividend increase was pretty small, and so that's what weights it down. If it weren't for the pandemic and the last dividend increase being smaller, that 5-year average would have been higher. Now, 3M comprises 2.8% of my portfolio. I would like to see that up maybe around 4%. So there's definitely, maybe even 5%. There's more room to go. Now, one thing I'd like to say, and I'll share this in Another slide today is this is a science and tech company trading at a cheap PE. And you really see this being exhibited by the recent news that with Neogen, there's going to be a reverse Morris Trust transaction where there's going to be a spin-off of sorts, tax favorable for investors. And I'm going to get to that in a little bit more detail in the video today. But when I started researching Neogen, I realized, wow, what they're doing is pretty scientific and pretty interesting. They're even working with the blockchain. And I noticed that they're going to be merging now with one of the units from 3M Company, which tells me that 3M Company is doing some pretty interesting things that a lot of investors don't even realize about. They just look at it as a sleepy industrial company, which creates more value for investors like me who can see the details. Now, I want to keep going. As you can see in front of you right now, the next stock on my list for 2022 is Raytheon Technologies. Man, I love this company because no one talks about it anymore. It used to be United Tech. They spun off Otis and Carrier, which I own both of, and those have done extremely well. And what I like about this company is it's an aerospace company, defense company, but also has a technology focus as well. There's a lot of technology involved in defense and aerospace. Now, what I would say about Raytheon, what I like is the forward PE this year is at 20, but next year dips down to 17, and that's why I highlight that 17.12. Now, the starting yield, it's not that high. It's at 2.39%, but that payout ratio is under 50%. So there's room to grow the dividend, especially because the earnings at the company are growing. And what I love, this is not a 5-year compound annual growth rate for Raytheon. This is a 1-year because it's a new company. And so just year over year, the last dividend increase was 7.59%. It's a new company in the sense that it's no longer includes Otis and Carrier, and now the old United Tech, the aerospace division, combined with Raytheon. And so I couldn't look at 5 years of data for dividend growth. I could look at 1 year. Again, I highlight that because 7.59% is above my target for average dividend growth. Now, Raytheon is only 1.5% of my portfolio. I'd like to see that up about 3, maybe 3.5, maybe even 4%. Now, if I add in Otis and Carrier, it's at 3.1. And so that's something to keep in mind, that the reason the allocation is so low is because they spun off Otis and Carrier. That being said, the core stock, RTX, I want to see the allocation more aggressive. Now, the next one on the list is important to underscore that it's not a value. I look at stocks 1 through 3, and that's why these are in descending priority order, are values. And I feel comfortable buying them at these value levels. PepsiCo, which is my number 2 favorite stock of all time, CPG food stock, is not a value. It's trading at a forward PE of 27 this year, 25 next year. It has a payout ratio of 68%, so I don't think they're going to increase the dividend quite as much as they have in the last 5 years, but on average, they've been increasing the dividend by 7.39%. Starting yield is not that exciting at 2.51%, but the fact that they're growing it really is. Now, despite the fact that PepsiCo is trading at a high valuation, I like the fact that it's my number 2 favorite stock of all time. It has a current portfolio of allocation of about 5.6%. I'd like to see this trading up at about 9 or 10% of my portfolio. And so, quite frankly, it's expensive, but I want to increase exposure to my number 2 favorite stock. So I'm going to pay up for quality. That's going to be part of my strategy this year. I list it in priority 4. I won't buy as much Pepsi this year as I will of Johnson & Johnson, 3M, and RTX, but I will. I'm going to pay up for quality, and that is okay. I would much rather buy quality and pay up for it than buy value that is not of high quality. The last one on the list is Starbucks. This one I list as a restaurant company, but it's also a technology company in my humble opinion. The way that they use technology in their app and with so much that they do. And I'd say it's almost a lifestyle as well. It's just, boy, in addition to coffee, I think it's just a place that people cannot really live without. And so what's so interesting about Starbucks, actually, it's not a value. It's just like Pepsi. It's expensive, but it's becoming more of a value. I think the earnings are finally catching up with the stock price. And the forward PE this year is 33, next year 28. When it's dipping down to kind of 28 territory, I like that. And whereas the starting dividend yield is only 1.72%, it has a reasonable payout ratio just above 50%. It's at 56.98%. And the 5-year dividend growth rate is 14.41%. That is staggering. And so StarBucks, I would say, is more of a long-term investment. Well, all of my stocks are long-term investments. I like to buy my dividend stocks and hold them forever. But what I'm saying is StarBucks almost pays homage to the strategy I had in 2021, which is a long-term approach. I'm not going to get so much meaningful cash flow from StarBucks right away, but if they keep increasing the dividend like this year in and year out, after another decade or so, boy, my cash flow from StarBucks is going to be amazing. And so that one is looking a lot further out. And as you can see on the screen in front of you right now, some of these stocks like 3M, they're going to pay me more cash flow right now. Now, StarBucks, I'm fortunate that my portfolio allocation is all the way up to 3.9%. I'd like to see that up maybe around 6, 7, 8%. I would be fine with it at 10%, quite frankly. And so it's expensive, but I'll tell you, this is a holding I am very passionate about. I want to have so much money in this thing one day that the company honestly is going to listen to me and maybe even put me on their board of directors. And so someone actually in the community, I thank you all, planted that seed in my mind. It was in one of my comments. By the way, if you're enjoying the video so far, please go ahead and smash the like button. It means the world. And also don't forget to subscribe as well. I have more videos on the way all the time. And drop a comment below. It was in the comments below that someone said, Ian, you're buying so much StarBucks, one day you're going to be on the board. I am not there yet, but one day I hope to be at that level. Or if I'm not on the board, at least I have so much stock that the company is going to listen to me quite a bit on certain things. We'll see. I'm kind of joking about it, but I'm also not joking about it. I'm serious. You got to have big goals in life, and I love this company, and so I'm going to add more. And so those are the 5 that I have for 2022. Now, what I want to do next is I want to go through some news for each of these because I have a lot of updates on these stocks, a lot of it which I don't think the community is even aware of. And so let's go into segment 3 today. As you can see on the screen in front of you right now, I'm going to start with Johnson & Johnson, and so I'm just going to go in chronological order. And so what I want to do here is just share the J&J Q3 results. Total sales growth was 10.7%, with operational growth 9.9%. And adjusted operational growth was 10.6%. So this company is growing really, really well. And so what I also want to share is the company is increasing 2021 full year guidance. And so this is something really important to keep in mind. Most of these 5 stocks that I'm going through today, as you'll see in the news, they're increasing guidance. If they're increasing guidance, it means they're performing very well, even better than they thought they would perform. So we're coming out of the pandemic. And of course, these quality stocks, these 5 stocks alone, honestly could comprise an entire dividend stock portfolio. And it would be such a high quality dividend stock portfolio. All 5 of these are just firing on all cylinders, and they did just fine throughout the pandemic, and they're doing even better now. And so that's what I wanted to share on J&J, actually the first bit of news. The next one, as you can see on the screen in front of you, I have shared this on my channel before, but I know I have a lot of new subscribers all the time. So I just want to give this outlook as well, that J&J announces plans to basically unlock value by separating their consumer health business. So shareholders of J&J in the future will not only own J&J, but they'll own another company that represents the consumer business. And I believe the reason they're doing it is probably to unlock some value, but also to mitigate legal risk. And so that is really important news coming out of J&J. Am I so excited about it splitting up? Not necessarily. I really liked it being one company, but I also respect and understand why they're doing what they're doing, because our world is ever evolving. And so they have to keep a mind on protecting shareholder value. And so that's J&J. I want to move into the next stock. So as you can see in front of you on the screen right now, the next one on the list today is 3M. And check this out. They reported their third quarter 2021 results, and sales were up 7.1% year over year. Organic local currency sales 6.3% year over year. And they're returning $1.4 billion to shareholders via dividends and share repurchases. I always love it when I see something like this, because it clearly shows that the company cares about the shareholders, which should happen. It should be one of the main reasons they're in business is to reward the shareholders like you and me. And so when I see a shareholder-focused company like 3M, it means the world. And as you can see in front of you right now, the last bullet point, which is so important, is they updated their full year 2021 outlook. And when you look at that, what does update mean? Actually, it means they increased it. If you go all the way to the bottom of the slide, you can see the updated guidance is higher than the prior guidance, I guess, for sales growth. For organic local currency sales growth, it's also a little bit higher. Earnings per share, it actually narrows a little bit. It looks like a little bit down. So it's I guess the top end of the range is a little bit down. So I guess it is a true update of their outlook, but I would mostly look at that as positive, especially with the top line sales growth higher than the prior guidance. And so that is the first slide on 3M. The next one I want to share that so many people did not even see. So if you're a 3M shareholder, go ahead and smash the like button if you love the company as much as I do. No one's talking about it, and that's why everyone missed this news, but I shared it on my Twitter today, and I'll include a link to that in the pinned comment, and I'm going to share it here. As you can see in front of you right now, the next thing I want to share with 3M is they have this big news, and maybe people missed it just because it was around the holidays, and happy holidays, everyone. Neogen, which is a publicly traded company, they're going to combine 3M's food safety business with its existing operations. And so what Neogen does is it uses technology, and it uses technology to track food. They even have partnered with blockchain company. I was reading a press release about that, and they track food safety. And so when you and I go to the supermarket or go to a big box retailer and we're buying food and we're consuming that food, we can rest assured more or less that everyone is making their best effort to protect the food and the integrity of the food and the safety of the food, thanks to companies like Neogen. And what's happening now with Neogen is they're combining forces with 3M. And what this means is literally through a reverse Morris trust, which is going to be a tax-favored transaction. There should be no tax element to it all for shareholders. They're going to earn shares in the new Neogen company. So now that I own shares in 3M, for example, my portfolio will not only include 3M, but I'm going to include the Neogen 3M combined company after this reverse Morris trust has happened. And so this is very similar to what happened with Pfizer. Many of you remember, I own Pfizer, by the way, and they spun off their Upjohn business unit. It combined with Mylan to create Viatris. That was a reverse Morris trust transaction. This is very similar with 3M. They're going to spin off their food safety division. It's going to combine with Neogen, reverse Morris trust. And so now shareholders are going to own that as well. And I like to keep my spin-offs, my reverse Morris trusts, all that kind of stuff. And so I'm going to have another new stock in my portfolio. Drop a comment below. What are you going to do? Are you going to keep it? Are you going to sell it? If you look at Neogen's stock chart, you're going to see that this is a growth company. It's a tech company. And so what I'm trying to say is even a dividend investor investing in relatively conservative stocks like 3M, there's always opportunities for long-term technology and capital appreciation exposure, which is exactly what's happening here with this entire Neogen deal. And so with that, I want to go on to the next stock. As you can see on the screen right now, I want to talk about more news. And this is the outlook from Raytheon Technologies. And so Raytheon Technologies recently reported their third quarter 2021 results, and they raised their 2021 adjusted EPS outlook. It's really the headline that says it all. That's what I wanted to share, is the company is doing very well. It's come out of the pandemic strong, and they increased the outlook. And so that was the main thing I wanted to share, that all 5 of these are really high quality dividend stocks. Let's keep moving on. PepsiCo, as you can see in front of you right now, I have more good news. And so PepsiCo, the third quarter 2021 results, again, same headline, raises full year guidance. And so we're seeing net revenue growth year to date 13.2%. Perhaps that's why it's trading at such a premium valuation. We can see that the EPS is up 20% year to date versus the prior year comparable quarters. And so this company is doing very, very well. And perhaps that's why it's trading at these high valuations. I have one more slide, as you can see in front of you right now, with the next company. I want to talk about Starbucks. And so Starbucks reported their Q4. Now they're on a fiscal year, and it was a record Q4. And so they basically said that net revenues are up 31% to a record 8.1 billion. Everyone thought, I remember when I was buying this thing during the pandemic, oh no, no one's going to pay for coffee anymore. That could not be further from the truth. And so what I have found is these simple pleasures that make life in modern times, which is so difficult, just a little bit better. Consumers will never let those go. They will spend their last dollar at Starbucks, and I honestly do not blame them. And so the Q4 comparable store sales are up 17% globally, and they are just doing really well. Their active Starbucks Reward membership is approaching 25 million, which is 28% up year over year. Here's my favorite bullet point on the entire thing. The company commits to a 20 billion share repurchases and dividends over the next 3 years. I also like that they're rewarding their partners, their employees, by bringing the average retail hourly wage up, and so to nearly 17 an hour. One of the things that I think makes Starbucks so special is the quality of customer service. And I think the quality of customer service is driven by hiring the right partners or baristas or employees, whatever way you want to call them. But shout out, if any Starbucks employees or partners are watching, I really appreciate what you do. It means a lot. And so that's that, everyone. Those are the 5. Let me know in the comments below what you think. I want to wish all of you a Merry Christmas, Happy Holidays, really happy new year. I am so excited, and I'd like to know in the comments below, what are your strategic themes for the new year? And if you're not on my crypto channel yet, check out the pinned comment, the description below. Head on over there. I have a new video I'm working on where I will share my strategic imperatives for my cryptocurrency portfolio next year as well. If you enjoyed the video, don't forget to smash the like button. That is one of the best ways you can thank me. Don't forget to subscribe with that notification bell because I have new videos all the time. And don't forget to check out my Patreon. You can see my entire dividend stock portfolio over there at the corner patron tier, the percentage I've invested in each of my dividend stocks. And on all tiers of Patreon, my backyard tier and corner tier, I'm sharing all of my stock trades, and I have so much more value over there as well. If you want to learn more about it, check out the pinned comment below. I love you all. Thank you for watching the video today. Before I leave, in terms of a full disclosure, I want to go through the stocks I mentioned today that I own, which is basically all of them. I am long Starbucks, ticker SBUX. 3M, ticker MMM. I am long McDonald's, MCD, the Home Depot, HD. I am long Utz Brands, Inc., UTZ. I am long Coinbase, COIN, Dutch Bros, BROS. I am long Apple, AAPL, Johnson & Johnson, JNJ. I am long Raytheon Technologies, ticker RTX, Otis, ticker OTIS, Carrier, ticker CARR. I am long PepsiCo, ticker PEP. I'm long Pfizer, PFE, and VTRS. Also, I'm a cryptocurrency investor, and I'm long various cryptocurrencies as well, including Bitcoin, ticker BTC. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose a ton of money in the stock market. It's very risky, as are the crypto markets. I'm just sharing my journey for fun. All right, everyone. I love you all. Thank you for watching. I'll see you in the next video.